So investing in yourself is the best thing you can do. Anything that improves your own talents, nobody can tax or take away from you. So having a subject matter expertise, if you're good at healthcare, if you're good at education, if you're good at banking, certain like any field that you've studied in university, college, in the workplace, you can use that information to invest. So any knowledge you have is that's the most important thing to investing because you can find out what the risks are and what the returns are. So I'll ask the class, what topics are you experts in? So don't be modest. Be be confident. Yeah. So if you're an expert in a subject matter, let me know, and then that could be a potential place to invest for you. So what do you know? What do you know about most from education, experience? So one student told me the other day, so Nazhat says I still haven't developed any expertise yet. Okay, that's okay. So the anything that you study, so right now you're in the global business management program. So anything related to businesses who trade internationally, you could potentially you could potentially invest be an expert in that area. So like an Amazon, for example, would be a potential company that you may know a lot about because of what you've studied. A lot of what this program is about international trade, and Amazon is very involved with international trade. So we'd have an edge in analyzing companies that trade a lot over borders. So that could be a potential area that we could invest in. So as far as I'm concerned, the stock market doesn't exist. So what he means by that is that prices go up and down. It doesn't matter where the prices go. It's all about how the company is internally. So what their operations are, how their finances are, that's the only thing that matters. We shouldn't be looking at the stock price. All we want is to be in businesses that we understand, run by people whom we like, and price attractively relative to the future prospects. I buy businesses, not stocks, businesses I would be willing to own forever. Invest within your circle of competence. It's not how big the circle is that counts, it's how well you define the parameters. When management with an excellent reputation meets a business with a poor reputation, is usually a business's reputation that remains intact. So you want to invest in stuff you understand. You want to focus on it as a business. So look at the business side, and also the company, you must trust the management. You got to trust the management, you got to believe in the management, and they got to be trustworthy. So so here, for investing, it's good when the price is lower because you're getting the business at a cheaper price. So it's basically on sale. It's the same business, but you can buy it for a cheaper price. So if you so for example, Amazon is a great business, and if you can buy it at a cheap price, it's still the same Amazon. It's not like it's went down in value. It's just a cheaper price. So that's why we don't worry about the price day to day, because we just worry about how the business is doing. So we should track if the business is operating still fine. If they don't have any issues, then we'll still buy it. Recognize that the majority of investors play short-term game. So most investors just sell when they panic, buy when they fear missing out. You shouldn't do that. Only buy when you think the company is a great company. Sell when you think the company is falling apart. So those are the things that you should really focus on. People selling bad news. So that can be fine if the news is going to affect the operations. If the news is really going to make the company fall apart, then sell. But if the news is not going to affect the company at all, don't sell. It might just be gossip. So look at it case by case. Companies that have franchise product and thus competitive advantage have the economic power to weather most bad news storms. Always invest in companies with a long-term durable competitive advantage, which we call a franchise product. Products characterized by fewer and no substitutes, product in demand by many, little or no government regulation. So can you think of a company with a long-term competitive advantage and with few competitors and has a lot of demand? I wouldn't say Tesla anymore. I think a few years ago they used to be like this, but now because there's just so much more competition with BYD, Ford, GM, Volkswagen, Mercedes-Benz, Fiat, all these other companies, they've come along and they're taking a lot of Teslas. They're making it very hard for Tesla. I would say that Tesla isn't anymore. It used to be though. IKEA, yes. So I would agree. IKEA, there's not a lot of there's not a lot of competitors for that for IKEA in terms of how they do business. It's a very specific business that they provide. Yes, I would say IKEA could fit that because there's not a lot of stores like IKEA out there. Yeah. Any other ideas for that? So I'd say Amazon would meet that criteria. Pepsi, Coca-Cola, those ones would meet that criteria. I would say. Yeah, so those ones would meet that criteria. Google, Disney. Yeah, Disney's a great example too. Yeah, Gioza, yes. So all these would have not a lot of competition, a lot of demand, and very little government regulation. YouTube, yes. YouTube's a great example. So Google owns YouTube, and YouTube's effectively a monopoly in that type of video, free videos online. Because there are some competitors, but they're not even close to that big. Microsoft is another one. So a good example. Microsoft is not a lot of substitutes. It's in demand by many. We run Windows. Almost everybody runs Windows, uh, except for some people who have a Mac. Adobe. So Adobe, I'm not sure about Adobe. I'm not sure what the competition is, so it may fit that. That's possible. I'm not familiar enough with Adobe's industry, but you might be right about that if they don't have a lot of competition. Yes. So yeah, great examples here. So yeah, that these could potentially be good investments. So market volatility, your best friend. So if it's a great company like the ones we named that fit the competitive advantage idea, so like a Disney, we would want to buy it as low as possible. Because if you bought Disney at the lowest possible point, it's going to go back up. Because Disney is such a outstanding company that it will go back up. It just has such a competitive advantage over their competition that and a very durable long-term competitive advantage. So their company will recover and you could buy it cheap and then make a lot more money if you buy it cheap. So turn off the stock market. Remember, the stock market is manic depressive, wildly excited sometimes or unreasonably depressed. This behavior creates opportunities, but you do not allow the market to dictate your actions. So don't look at the stock market. Don't worry about the economy. Buy business that has opportunity to profit in the economy. Buy business on stock. Change your perspective to that of a business owner and learn as much as possible about the business and industry. Manage portfolio businesses. Don't diversify for diversification's sake. So make sure that this is the one thing I disagree with Warren Buffett's strategy. I believe that we should diversify for countries and industries. So we should own investments all across countries. So own investments in Canada, own investments in the United States, own investments in Europe, own investments in Asia, own investments in Africa, and diversify across industries. So own investments in railroads, own investments in banks, own investments in technology, own investments in consumer goods, own investments in construction, that kind of stuff. So own investments across countries and industries. And the best way to do that is through exchange traded funds. So exchange traded funds through Bank of Montreal, TD Bank, Vanguard, iShares, and Fidelity are the best way. So exchange traded funds for industries and countries through BMO, TD Bank, Vanguard, iShares, and Fidelity are the best way to invest. Provide diversification to minimize risk. So I recommend that's the best way to invest. Concepts every investor should know. So when interest rates rise, business becomes more difficult and vulnerable. This is due to the high cost of borrowing money to invest in business. When interest rates decrease, it is easier to borrow capital and therefore expand capacity and activity. Hence, interest rates are the price of borrowing capital in business. In Finance 101, you should already have studied the before and after tax costs and borrowing capital. So lower interest rates are better for stocks, while higher interest rates are bad for stocks. That's the general. And then you want to invest because it protects you from inflation. So I'll show you here. If you invested in the S&P 500 here and the or long-term bonds, long-term government bonds or T-bills here, you will make more interest than the inflation. So inflation is the CPI here. You always want your investment to be more than inflation as a return. So as you can see, all these returns here are higher than the CPI inflation. And that means that you'll protect yourself against inflation eating away at your money. That's one of the reasons why we invest, because inflation eats away at the value of cash. Cash goes down in value because of inflation. You can buy less each year because of inflation. You buy less per dollar each year because of inflation. But if you invest, that will protect you against the inflation. So also another good strategy that you can use is that when interest rates go down, bond prices go up. So if you believe interest rates will go down, buy a bond exchange traded fund from Fidelity, iShares, Vanguard, BMO, and TD Bank to profit off of higher bond prices. So lower interest rates cause higher bond prices. So financial statements. So let's skip this one because this one, the problem with net income here is that net income is misleading. So Enron, for example, they made up their net income here. So for Enron, they made up the net income. The problem with net income is that with mark-to-market accounting, it could be made up, could be fake. Profits could be made up out of thin air and not real. So that's what mark-to-market accounting can do. Also, sometimes net income is not received yet. Sometimes it's still in receivables and you still have to collect on it and still not in your it's still not in your bank account. So that's a big problem because you may go bankrupt because you don't have the money yet. So this is the problem with the income statement. The balance sheet is useful because so some of the statistics that I look at, inventories are important to look at. You don't want a company having too much inventory because if the company doesn't sell the inventory, it's worthless. So if Apple here had a lot of inventory, if it was a lot more than this, then that would be a big risk because if they can't find buyers for that inventory, it's worthless. So so that could be a big issue. And then cash and cash equivalents is great because this is received by the business. So as you can see, it's went up about 19-20% per year. So it shows that the company is receiving more and more cash. So this is real cash that the company has. They don't have to wait for it. It's already there. Receivables, like I talked about, this is an issue because you haven't received this yet. You still have to collect from people on this. And this is a big concern that's growing at 19, 18, 25% per year because it's possible they'll never pay you back. So that's a big risk that you have there. So that can be a big problem also here. Then something else you want to look at is how fast the liabilities are growing. As you can see here, they're growing very fast. Went from 57 billion to 120 billion, so that's a big jump. And that's led to stockholders' equity going down. So that could be a concern. But then again, Apple needs a lot of liabilities to run their business because they need a lot of money to fund their business. So that's why they're borrowing a lot. So that might be a good reason. So I'll post this in the chat. But also this PowerPoint is under week 6 in learning in the learning resources. So some statistics here to look at are current ratio. It's going down, like we said, because they might be borrowing more to fund their inventory. So liabilities are debt. So liabilities are debt. So if liabilities go up, they are borrowing more, which causes an issue if the company cannot pay the liabilities. So that can become an issue, but they may be able to take more liabilities on because they have money coming in. And I'll show you why they're able to take more debt on. And their debt to equity doubled during this period, which is a concern. But the reason why they can do this, I'll show you why they can do this. The return on equity is one of the most important statistics that you look at. So the current ratio is going down, debt to equity doubled, but this is because the return on equity is 30% or above during this period. So they're generating so much money that they can pay off the debt quicker. So if they have a return on equity of this high, then they're making enough money to pay off their debts. So they can take on more debts. They can take on a lot more debt because they have the money to pay off that debt through the high return on equity. So if they had a low return on equity, then that would be a real concern because they wouldn't be able to pay off all that debt they're taking on. So as long as their return on equity is high, they're making enough money to pay off their debt. So that's a good thing. But you'd have to keep track of the return on equity and make sure it's still high over time because they need a high one to pay off their debt. And that's the only way they'll be able to pay off all this debt. So there are some reports that I recommend reading: the 10K annual report, the 10Q quarterly report, and the AQ current report filing. Those are great reports to read for studying about companies. So the basic ideas of investing are to look at stocks and businesses, use market fluctuations to your advantage, and seek a margin of safety. That's what Ben Graham taught us. 100 years from now, they will still be the cornerstones of investing. So these are good questions to ask about your investment. Is the business simple and easy to understand? Does the business have a consistent operating history? Does the business have favorable long-term prospects? Is management rational? Is management candid with shareholders? Does management resist the institutional imperative? Focus on return on equity, not earnings per share. Calculate shareholders' intrinsic value. Look for companies with high profit margins. Make sure the value add is greater than 1. What is the intrinsic value of the business? Can the business be purchased at a discount to its market value? Does the company have an identifiable durable competitive advantage? Does the business have an identifiable consumer monopoly or franchise product? What is the chance the product will become obsolete in the next 20 years? So is business simple and understandable? What does that mean? Does the business make a product that's simple or complex for the average investor to understand? An example would be See's Candy. Everyone can relate to See's Candy, especially on special occasions. It doesn't take a lot of new technology to continue to make the product, and it is relatively insulated from increasing prices. Compare this to an Intel, whose products may lead the market, but it does take a lot of reinvestment of capital to maintain a competitive edge. So See's Candy is great because the company's always, you don't really have to change C's Candy's product is always going to be this, it's always going to be the same. You don't really have to change candy because candy's candy even 100 years ago or 100 years ago from now. While Intel, with any technology business, technology changes every day. So you have to keep up with competitors. And if you don't, you're going to lose all your market share. So does the business have a consistent operating history? So Apple, as we can see, the average cash flow growth over 5 years is 57.4%. So that's really good. They're generating so much cash. This is the best statistic to look at for investing is average cash flow growth. It's 57.4% per year over this 5 year period. So that's great. They're generating enough cash to pay off their debts. Their average return on equity is 30.73%, which is very high. So these two statistics are really the most important to look at here. And as you can see, they're very high. So good question. So return on equity, I would recommend 20% or higher. So higher than 20% is good. I'd recommend if it's 20% or higher, it's very good. And free cash flow growth should be 20% or higher. Yeah. So cash flow growth and return on equity growth should be above 20%. And in this case, they are. So that's a good sign there. Yeah. So as you can see with Apple, it's growing very fast here.
So can you come again with the last statement, cash flow growth and the percentage?
Yeah. So it should be above 20%.
Okay.
So as long as it's above 20%, it's growing very fast.
All right. Thank you,
And the
sir.
great thing, there's no problem. The great thing about cash flow growth is that cash flow is received by the business. You don't have to wait for it. You don't have to collect on it. You don't have to worry about it not coming in. It's already in the bank. That's the benefit of it. You don't have to worry about some company not paying it back or customer. It's already in your bank. So it's already there. You don't have to worry about going bankrupt because you have it. That's the benefit of cash flow growth. It's real. It's real. It's not fake. They can't make it up. So that's a big benefit of it. So an investor needs to do very few things right as long as he or she avoids big mistakes. We like stocks to generate high returns on invested capital, but there's a strong likelihood that it will continue to do so. I'll look at long-term competitive advantage and whether that's something that's enduring. So a bond is when you lend to a borrower. So buying a bond is when you lend to a company. So it's profitable because you will get interest from the bond and it may go up in value if the interest rate goes down. So you get interest from the bond and it may go up in value if the interest rate goes down. So you get interest every quarter. So you get interest every twice a year usually from a bond, and the bond price may go up due to lower interest rates. So those are two ways you make money through a bond. Yeah. So there are some things that we have to worry about here. No problem. So none of the stuff that I talked about before will matter if the management is not trustworthy. So if the management is not trustworthy and they're criminals, they're scam artists, they're fraudsters, if they're all those any of those things or all those things, if you can't trust them, then none of those matter. None of those numbers matter. So the investment will likely you will likely lose all your money in your investment if they are scammers, fraudsters, liars. You can't trust them because they could potentially make up a lot of, they could potentially steal your money through stealing money from the company, through a lot of situations. They could be it could be a criminal enterprise, it could be money laundering. So there's a lot of issues that happen if they're liars, you can't trust them. Also, you don't want the management to just imitate the competition. That's a problem. So you don't want management to just imitate everyone else because that will not allow them to have a competitive advantage. So yeah, like you want managers of high character running the business, and integrity is so important. So like I said, trustworthiness, they have to be trustworthy. That's more important than everything else. If they're not trustworthy, everything else doesn't matter. So institutional imperative is when the company doesn't want to change, the company just is lazy. Also, the company has a lot of yes men, and the company just imitates the competition. That's the problem here. So you don't want to invest in companies that are like this. Can you think of any company that is like this? So can you think of any company that just imitates the competition, wastes time and money, resists change, and there's a lot of yes people? Yeah, Nokia is a good example. Yeah. Also, BlackBerry is the biggest example that I can think of. So Nokia would be under that too. BlackBerry, yes. Excellent. That's hot. That's great. Yeah, just avoid investment in companies like this. So what is the return on equity? What are the company's owners' cash flows? What are the profit margins? Has the company created at least $1 market value for every dollar retained, value added? Does the company have at least have less than 30% debt? So these are questions you should ask about your investment too. So yeah, these are very important questions to ask too. So what is the business value of the company? That's intrinsic value. The company must have capable and vigilant leaders. The company must have long-term prospects. Is the stock stable and understandable? Company must be undervalued so you can make a good buy. So low debt to equity of less than or equal to 0.5, and a debt to total assets less than or equal to 0.3. High current ratio greater than 1.5. Strong and consistent return on equity. Buffett requires 8% average over a 10-year period. Appropriate management incentives. So I'll put this in the chat too. So the kind of business to invest in is one which is durable, franchise product, meaning that the business must be able to keep its competitive advantage well into the future without having to expend great amounts of capital to maintain it. A low cost competitive advantage is important for two reasons. First is predictability of the future earning power. Second, it improves the chance the business can expand shareholders' fortunes rather than having to expend capital. Franchise product has a durable product with a competitive advantage that's sustainable in the long run, 5 to 10 years, in high demand by a large segment of the market, little or no close substitutes, little or no government regulation. So the example used in the book is a good one. While Apple is a consistently high performer, they must stay ahead of the curve by investing in R&D and coming out with new products that may replace major products already in the market. This doesn't mean that Apple won't be profitable in the future. It means that there will always be more uncertainty attached to the products. Graham always told us that speculation of the future was no way to invest. A steady Eddie like Coke already has a record for solid long-term success with its current franchise products. So a Coca-Cola, since it's not a technology company, the product doesn't change much, so there's less risk because the competitor won't come ahead in terms of the product quality. Well, Apple, the technology is changing every day, and you need to keep up to keep your great technology because product quality changes. Product quality changes a lot in technology compared to other industries. So when considering a new investment, you should aim to determine whether changing technology will have a significant effect on the demand for that product in the future. This would establish a long-term competitive advantage. You must be able to ascertain this feasibility of franchise product at least 10 years in the future. When Buffett says he doesn't understand a business, he means he knows how it works, but he doesn't know how this future looks like. Again, it comes down to the simplicity of the business and then the investing story. Mr. Buffett says the chance of being way wrong about Coke, where he does own shares, are probably less than being way wrong on Apple or Google. Ultimately, he says, I just don't know how to value. So minimizing taxes. So for example, so here, if you invest $50,000 in a 10% investment and hold for 20 years, it will turn into $336,000, 335. So it goes up by that amount. So it goes from 50,000 to 336,000. That's a huge return if you don't sell at all during that 20-year period. But then again, if the company's falling apart, you should sell. So if you know the company's going to fall apart, you should sell. But if you know the company's going to stay consistent, you should keep the investment. So I'm going to show an example here of Able, and they were consistent and they weren't having issues like that. You would still hold it. So you'd have to just monitor and make sure the company's consistent, it's not falling apart. Yeah. But here is the difference. If you sold every year for an investment, if you invested $50,000 in 10% investment and sell every year, so you sell after year one, sell after year two, reinvest back in after selling, you'd make 200,847 compared to 336,000. So you make $136,000 less if you sell every year. So if you just hold it for the whole time, you make 336,000, while if you sell every year, you make 200,000. So there's a big difference. That's why holding an investment for the long term is better. You'll make a lot more money. So according to Buffett, what causes risk? Excessive debt. Buffett never considers a company that has a debt to total asset ratio greater than 30%. Overpaying for an investment. Price you pay for a stock should have potential for at least a 50% premium. That is, for every dollar you spend for an asset, you should get at least $1.50 in intrinsic value. Not knowing what you're doing, that is